Okay, so you know that feeling. The Fed makes a decision or maybe doesn't, and you're trying to cut through the noise, figure out what it means for you. Well, that's exactly what we're digging into today.
Yep. The Federal Reserve just wrapped up its meeting. This was May 7th, 2025. And the main takeaway, interest rates are staying put.
Holding steady.
Exactly. That target range for the federal funds rate, it's still 5.25% to 5.50%.
And that's been the case since, what, July 2023?
That's right. Been there for a while now. So look, the fact they didn't move isn't, the shocker. It's the why behind it. That's what's really interesting here.
Okay, and that's where we're turning to some insights from Chris Lehnes. He's a factoring specialist who put out his analysis right after the announcement on the 7th. So think of this as our way to kind of unpack those economic signals without needing a PhD. Right. All right, so the big question, why hold? Why not make a move?
Well, it really comes back to the Fed's main job, their dual mandate. They want maximum employment, and they want stable prices.
Yeah.
Stable prices means hitting that 2% inflation target. Now, inflation has come down from, those really high peaks in 2022, no doubt about that. But the issue is it's not cooling off fast enough for their liking.
Ah, that stickiness we keep hearing about.
Exactly. The Lehnes really points this out. Core inflation, so that's when you strip out the bouncy food and energy prices, right?
Yeah.
That core number, especially for things like housing and services, it's just proving really stubborn. It's sticking around.
Yeah, and the numbers back that up. That March CPI reading, the main inflation number, was 3.5% year over year. Still quite a way off from 2%.
Well, a long way off. And core was elevated, too. It's, if you dig into why, like housing, you've got leases that take time to adjust. Services, you still have some wage pressure, even if it's easing a bit, feeding into costs.
Right.
And Fitcher Powell basically said it outright after the meeting. He mentioned being, quote, prepared to maintain a restrictive stance until we are confident inflation is sustainably headed toward 2%.
Pretty clear message there. Okay, so inflation's the main driver, but it's not the only thing they watch, is it? The job market plays a big role, too.
Oh, absolutely. That's the other side of their mandate.
Yeah.
And the labor market picture is, well, it's evolving. It's another key piece of the puzzle.
Evolving how? What are we seeing?
Well, the April jobs report, it showed some signs of cooling off. Job growth wasn't as strong as people expected, and the unemployment rate ticked up just a tiny bit.
Okay, so maybe not overheating anymore.
Yeah, and crucially, wage growth has also slowed down a bit. That suggests maybe less pressure pushing inflation up from, employers having to pay way more to find workers.
So it sounds like, okay, inflation's still too hot, but the job market might be cooling down. They're trying to balance those two, right?
That's the tightrope walk, exactly.
Like, they don't want to tighten rates more if the job market's already softening, because that could risk, well, a recession.
Precisely. That's a huge risk they want to avoid. So by just holding rates where they are, they kind of give themselves breathing room. They can wait, watch the data, see how things play out from the hikes they've already done.
A cautious approach, then.
Very much so.
Uh-huh.
And it definitely signals that anyone hoping for rate cuts, like right now, they probably need to adjust their expectations.
Yeah, Lehnes highlights that Powell quote again about needing greater confidence on inflation heading to 2% before cutting. Sounds like a high bar.
It is. And it's fascinating, really, how much the market thinking has shifted on this.
Also.
Well, think back to the beginning of 2025. People were talking about, maybe 6 rate cuts this year? Something like that?
Yeah, that was the expectation for a while.
And now, the conversation is totally different. Maybe 1 cut, maybe 2. Probably later in the year, and likely only if the economy really starts to look weaker. It shows how the Fed's messaging has sort of reset things.
And it's not just the U.S. economy they're looking at, right? Lehnes mentions global factors, too.
Yeah, that's another layer. You can't ignore the rest of the world. Inflation is still sticky over in Europe. You've got geopolitical tensions bubbling up. Supply chains are maybe still not totally smooth.
Mm-hmm.
All that adds uncertainty. It makes the Fed perhaps lean towards being a bit more cautious, Don't rock the boat too much.
And keeping rates where they are not hiking, but not cutting that, also plays into financial stability, doesn't it? Trying not to, create new problems.
Absolutely. It's about trying to reduce the risk of things like asset bubbles or people borrowing way too much without putting even more strain on borrowers who are already dealing with higher costs. It's a really delicate balance.
So, okay, let's bring it down to brass tacks. For businesses, for investors, what does this patience message really mean day to day?
Well, for businesses, look, it probably moves borrowing costs stay up for a while longer. That puts pressure on decisions about investing, expanding, profitability. But the flip side is there's maybe a bit more stability now. The Fed isn't constantly surprising people. For investors, maybe less wild swings based on Fed policy guesses.
Right.
But they also need to accept that rates might stay higher for longer than maybe they thought a few months ago, adjusting to that reality.
And it all comes back to the data, as Lehnes points out. What happens next really depends on what the numbers show in the coming months.
Exactly. It's all data dependent. They'll be watching inflation progress like hawks. How are consumers holding up? Is the job market still cooling, or does it stabilize? Those are the key things.
So this pause continues, but the future path, still very much up in the air, depending on that data.
Couldn't have said it better myself.
Okay, so just to quickly recap then. Fed holds rates steady May 7th. Main reason. Inflation, especially core, just isn't coming down fast enough yet.
Right. Stubbornly high.
They're also watching a job market that's showing some signs of softening, and they've got one eye on global uncertainties. And the bottom line seems to be, don't hold your breath for rate cuts anytime soon.
That sums it up perfectly. They're in wait-and-see mode, watching the data, staying cautious.
Right. Which brings us to a final thought for you, listening in. Given how much the Fed is relying on that incoming data and how things keep shifting, what single piece of economic news do you think will be the biggest trigger for their next move on interest rates? Something to chew on as we all watch how this unfolds.